On April 10, 2026, the March U.S. CPI release delivered a headline inflation print of 3.3% year-over-year. While the top-line numbers showed a notable jump, core CPI remained stable and actually came in below market expectations, creating the primary tension for today's trade. According to NaNa and Benjamin Cowen, headline inflation jumped from 2.4% to 3.3% in just 1 month, a move largely driven by record gasoline prices. This spike is directly impacting policy expectations. Benjamin Cowen notes that markets now see a 98% chance the Fed holds rates steady in late April, with a 90% chance of no cuts until October. While these macro hurdles are significant, a technical buffer is currently helping support the tape. But there is a technical buffer in play. Goldman Sachs projections shared by NaNa show $45 billion in CTA buying expected next week. This mechanical wall of demand often triggers what's known as a mechanical peak, where algorithms automatically buy into market strength. On the policy front, Nick Timiraos observes that recent data doesn't yet reflect the full impact of energy costs from regional conflicts. This suggests the Fed has the flexibility to remain patient as they evaluate these supply-side pressures. Fundamental growth in the tech sector is providing a critical hedge against macro headwinds. NaNa reports that TSMC's first quarter revenue grew 35% year-over-year, exceeding expectations and confirming the strength of the AI infrastructure cycle. While this growth highlights robust demand, the industry is currently hitting a 12 to 18-month packaging bottleneck, which is beginning to shift the landscape for other major players. Beyond manufacturing volume, SuperTrader highlights a significant 12 to 18-month backlog in advanced packaging. This allows Intel to position its EMIB and Foveros technologies as key alternatives for those needing to bypass supply bottlenecks. Moving from hardware to the broader ecosystem, OptionsPlay points to Alphabet as the most vertically integrated company in the space. By owning the entire stack, from custom chips and cloud infrastructure to frontier models and distribution, Alphabet maintains a level of control that OptionsPlay believes supports higher margins and greater resilience as market competition increases. The S&P 500 is currently showing a unique valuation decoupling. The compound reports that while the nominal index fell only about 9% during the recent drawdown, the forward price-to-earnings ratio saw a much steeper correction of 18 to 19%. This contraction has been partially masked by corporate earnings estimates, which have continued to improve even as macro volatility increased. Since February 27th, oil prices have jumped nearly 47%, and 10-year yields have climbed 35 basis points. The compound notes that even with these heavy macro headwinds, the market has stayed surprisingly resilient. It seems a strong earnings buffer is doing the heavy lifting. By improving their bottom-line performance, companies are effectively jacking up the denominator in the price-to-earnings math, which helps offset the downward pressure usually caused by higher interest rates. Geopolitical shifts are also moving the energy landscape. OptionsPlay reports a 2-week ceasefire between the U.S. and Iran, contingent on reopening the Strait of Hormuz. While the news initially cooled energy prices, analysts warn that production won't recover overnight. Normalizing infrastructure and restarting capped wells can take months or even years, meaning the underlying supply constraints remain a factor. Benjamin Cowen describes this situation as a policy checkmate for the Federal Reserve. While labor indicators like job openings are showing signs of weakness, the spike in energy costs is keeping headline inflation elevated. This creates an energy inflation trap. The Fed is essentially stuck. Cutting rates to support the job market risks fueling a further inflation spiral. Goldman Sachs reports results on April 13th, where Investors Business Daily notes that revenue growth will likely hinge on an IPO market rebound. In consumer retail, Sven Carlin is flagging falling knife risks, particularly for Nike. He warns that a loss of competitive edge is starting to show up as stagnant revenue and shrinking margins for the brand. Continuing our signal sweep, Sven Carlin is flagging significant balance sheet risks at General Mills, specifically citing potential goodwill impairments. Additionally, SuperTrader forecasts that Tesla's valuation premium may shift towards SpaceX following its anticipated IPO. Turning to the watch list, SuperTrader identifies a potential buy range for Palantir between $100 and $115, targeting a rebound toward $150. In the income space, Dividend Bull reports that the MRNY covered call ETF is this year's top performer, up 59%. However, the channel reminds investors that the fund is down nearly 90% since its launch, due to significant share price erosion. Meanwhile, OptionsPlay notes the S&P 500 has reclaimed its 200-day moving average and the 6,600 resistance level. The market currently finds itself in a balancing act between that 3.3% inflation print and the $45 billion in projected algorithmic buying. Looking ahead, watch for Goldman Sachs earnings this Monday and TSMC's update on April 16th for further fundamental cues. You can find all cited sources and specific claims in the description. Subscribe for daily high-signal recaps.